Hello. Happy Wednesday, everyone. This is actually the highlight of my week. I was so looking forward to seeing all of you three guys and to have a great conversation together. So, welcome back, I would say, to Laurent, Lars, and To. Thank you for being here today, guys.
Thank
Thanks
you.
for having us.
Thanks for having us
We're
again.
we're equally motivated as you, Silvan.
I'm glad. I'm glad. Today, we're going to talk about the holy grail of entrepreneurship, aka exits. All three of you have sold company either recently or in the past. And I really want to talk more about that topic with you. So we have Laurent from Holycode, Lars from Yokoy, and To from SHERPANY. Maybe we can start with the first question to all of you, just a quick one to warm up. Let's start with you, Lars. Was an exit always part of your vision from day one, or was it more of something that just happened along the way?
Yes, I think that the way it happens as a sale was maybe not what we planned. I think you can also not plan like the type of exit that you will have. There's also the market that will show you opportunities. But I think when we started Yokoy, it was always the plan at some point to have an exit, right? To either IPO or sell the business. So I know that there's also businesses out there that go and they have the vision of building a company that gets 100 years old, 200 years old. It's actually also Travelperk that acquired Yokoy that has this vision. And for us, it was clear that at one point we will go for an exit.
Makes sense. How was that for you, To? Was it the same?
For us, it wasn't. When we started SHERPANY, I was a complete greenhorn in that sense. So I didn't even know that exit is a thing that you could go for or that you should aim for. So I think that matured over time. And it wasn't a goal in that sense of like we are founded that company to exit it. We wanted to build a business and we wanted to grow a business. I think that was what we were focusing on. And I think the topic of exit maybe sort of, especially when through our funding round in 2015, getting there more professional investors in, then sort of when that idea starts floating around and being socialized and starting growing in my head and also learning on what that actually means. And I had to first build my opinion. Is this a good thing or is it a bad thing or what is it actually?
Nice. Laurent, for you, you had the exit with Movu. Now you're building Holycode. Is the exit already something you think about today for Holycode as well?
No, it's a different business. So when I was at Dine Deal and I saw the sale to Ringier at that time, or the exit to Ringier, that basically showed me how this could be or should be done. And then for Movu, that was relatively clear. We need a strategic buyer at some point that puts this niche technology into something bigger. So there was relatively clear from the start that we'd be in this position one day. Holycode on the other side, that's maybe, as Lars said, more the kind of let's build something for the next 100 years company, but we're always open. If as Lars said, there opportunities might come up in the market where you say, okay, here we can actually achieve more together, and then we're open to it. But Holycode per se is our company, our baby, and we want to keep that.
Makes a lot of sense. And I want to stick with you, Laurent. Often the media portrays that the exit just happens overnight, but I think we all know it takes years, sometimes even decades of hard work and long nights probably to build something that is then worth selling. And I wonder, when you think about the founder's mindset, is it a good thing to think about a potential exit early on, or is that more counterproductive? You should focus on the business and not really waste any time thinking about the exit at all.
I think it's not either or, right? So as soon as you have investors in, they will always start talking to you about, what's the exit strategy? Where can we get that company? What do we need to achieve? So you can try not to think about it, but you'll be forced to think about it once you have investors in the company. As long as you don't have investors in the company, maybe you don't need to think about it and you can just focus fully on the product. But I think you have to do both sides. One thing is bottom up. What is the sort of company we're building? What are the product features and the problems we're solving for the client on the market? How do we get this to the next level? Build. And then on the other side, look at what is a potential buyer may be interested? What are they looking for? Is this in line with our vision? Is there even an exit market available for this kind of technology or product or whatever you're building? So I think you need to look at both sides, but you need to spend the big majority of the time on the product and not on the exit scenarios, in my opinion.
Otherwise you have nothing to sell, right? Lars, I want to pick up what you said before. You know, how do I as a founder even know if an exit is actually the right thing for me? I know you have investors, they want to capitalize on it, but you could also say, well, we do an IPO at one point, or we just have a profitable business and we keep sending them dividends very nicely to get their money back. How do you know whether an exit is actually good for you?
Yeah, it's a good question. I think it really depends on the business that you're in. It also depends on the market. If you look at the market that we are in with Yokoy and now TravelPerk, or if you look back when we started as ExpensorBot, where we were in, it was a very highly competitive market, a lot of players, and at some point it was clear to anyone consolidation will happen, right? So going back to what I was saying before, there's opportunities in the market. I think that that you should at least check. So yes, I think that is for us, it's a bit different than maybe for other businesses. I think there's a lot of innovation that is happening where it's not really clear. What I think though, and also to add on what you said, Laurent, I think what is really good is if at the start when you start a business, if you have that plan and you know, okay, this is the direction that we're going, but obviously you will look left and right and see if there's any opportunities that come along your way. So I think it will never go as planned as with any startup, I think. Also, when we raise money, usually it takes longer and everything is more expensive than we thought in the first iteration. But I think you know what I mean, right? Of having that plan. So that's why for us it was quite clear already in the beginning that yes, probably there's a lot. There will be a lot happening in that market. And also for me, I think when I invest into startups and also when I look at what do I find really exciting, I love crowded markets in B2B. I think that is really, really exciting, right? Because there's you have that great exit potential. You also have the potential of being the best in your field. You can learn a lot from your competition, which is way harder when you innovate and you do something very, very new. You first have to check, is there a market for it? And I think if you are going into a crowded space, you can work on your product, what you said, Laurent, you can make things better, you can make it more efficient, you can add AI to maybe where your competitors are still working with legacy. And I think that is really cool and will give you a lot of opportunities as well. And like later on when you're thinking of selling the business or IPOing. Yeah.
Amazing. Thank you, Lars, for sharing that. To, I also want to talk to you about the exit readiness of a company. Now we heard a bit about the founder's mindset, but what are some key milestones? I know this heavily depends on the company and the industry, but I'm sure there are some milestones, maybe revenue-wise, maybe profitability, etc., that you need to hit before anyone will actually buy your company or has even an interest in buying your company. I think you're still on mute. We cannot hear you. Sorry.
You touched the microphone, too.
Maybe you touched the microphone and it's red now.
Touch.
Now you're back. Yes, you're back. Perfect.
Perfect. If you touch the microphone, things happen. So I definitely haven't sold a sufficient number of businesses to be able to answer that question appropriately, because unfortunately the answer is really it depends, right? You have early exits, you have late exits, you have like opportunistic exits, you have strategic exits. There's so many different ways on how that can happen that I think it's super hard to sort of pinpoint any milestones. I think more generic, like wherever you are in your journey, there are a couple of things that help you. One is obviously being healthy. And what does healthy means, right? It depends. When you are early on, do you have a healthy mindset to innovation and to try out and to learn? And can you demonstrate that you have amazing talents? If you are more in a scale-up phase, can you show that you sort of can scale, that economics makes sense, that actually the growth story is believable? And then if you're more towards later stage of private equity, you're sort of, okay, you can show that you actually have a way to carry leverage, right? At the end of the day, private equity, it always comes sort of with the leverage and the debt mindset. So I think it really depends. So are you healthy in that sense where you are right now? Would be sort of my key advice on like looking around. And then second, yeah, it is, if there is customer traction, you can tell many stories.
You're in the game.
Yeah, I think they actually they buy there's three sort of parts that they buy in your business, right? They either buy your technology and IP, so something that makes you special. They buy your growth potential, your market potential, or they buy your business. I think those are like the three. And as Toby said, that depends on where you are usually in the journey, right? They buy your business at the day when you're usually profitable, been there for a while. It's a strong business. It comes with clear EBITDA or multiples or revenue multiples and stuff like that. Before that, it has more storytelling in it. So if they buy your potential as a scale up, that is showing the growth numbers. There's some ways of multipliers, etc. But multiples, but you're not really, maybe not even profitable yet because you're growing fast. So then there's still more selling to be done from you, showing them the vision. And if they buy your technology and IP, well, that's a very different game as well. So that comes. I mean, there's not a lot of multiples and revenue parts around that, but I think those are like the three things that you can really look at and say, where in these buckets do I fit with my current company? And that's what you're trying to sell.
I would add fourth one, which is talent. Right? They can also be that they acquire talent. If you manage by whatever reason to accumulate a high density of high value talents, then you're a target for a key hire.
So I think we will see that now even more. So when you see OpenAI, Meta, the war on like AI talent, we will see more of that for sure.
Yes,
there it shifts more to acqui-hires, right? Where they don't buy the
exactly.
company anymore. They just buy you out as a contractor.
Yeah.
I wonder from your experience, guys, the four different areas, where do you have the biggest leverage to actually drive valuation? Maybe I can ask that to you, Lars. We heard about you're profitable, you're growing fast. So sometimes it's a bit more storytelling early on, sometimes it's a bit less, and it's more focused on the numbers. Where do you have more wiggle room to negotiate?
Yeah, I think what Laurent, you described it perfectly, by the way. I think when you have the traditional way, you have a running business, you have a very clean EBITDA, you are profitable. I think it is more of a very simple calculation on getting the valuation. I think if you are in the space where technology is very important, so I think it's not just technology. Usually it's combined with technology as an add-on to an existing technology. So a company has a product and they think your technology on top would give them more access to clients. I think that is very, very interesting. I mean, also, if you look at the sale of Yokoy, right? We did not do the way of selling our business to a competition. I mean, also there's actually right now still a lot happening on consolidations where really competitors, they join forces and become one. What we did is we actually were acquired by our number one partner, TravelPerk, because travel and expense goes together. And you could also see that in the market that T&D would always go more together, travel and spend. So that is why we said, okay, this is a unique opportunity we have right now, to be one of the few players in the world, and actually the first one in Europe that is not on legacy software, to be this player that actually combines both, right? So I think there is a lot of leverage if you have the technology part to it, and there's a business case to grow the business, right, on both sides, right? Because TravelPerk is able to add spend on top, to get all the know-how in as well. I think that is also important. It's not just a product, but also us, the founders who are still in the business. We have amazing talent that is now also transferring this knowledge to the team of Travel Perks, so we can build a very, very strong sales force. And then also the other way around, right? All our existing clients that we have to add travel there as well, right? Which is an amazing story. And also if you look from a client view, I think this makes a lot of sense, right? Because you're actually adding more value to the offering.
I see we also get the first questions here from the audience, so I'm just going to bring them up as they show up. The first one is actually for you, To, and it's from Daniel. He asks, how do you prevent the talent post-acquisition to quit or leave? You are still with the company that acquired you. I think your co-founder recently left, so I think that's a really good question to how do you deal with that? Is that even part of an agreement?
I mean, part of an agreement doesn't help much. It has much to do like with leadership and how you go into. So so far we haven't. So Matthias left, yes, but that was mutual, and we didn't have anyone else who left voluntarily since then. So we're super proud of that, and I think it's a combination of different things. But one thing was that obviously it comes that if people love working in your organization, that's already a good starting point. But we involved the whole team very early on. So when we went into confirmatory due diligence, and we went with 3 parties in parallel to keep competitive tension high till the end. So when we went in confirmatory due diligence, against the advice of all our lawyers and advisors and everyone, we informed the whole team. We took everyone together and said, hey, we are entering that process. We don't know how it's going to end, but we trust you. You can handle that type of sensitive information, and let's see. So that, I think, was one of the moments where we created a lot of trust. And at the end of the day, you need trust in leadership to continue after. The second element, we were able to make everyone participate in our exit, and that was also an interesting discussion. So 5% of the whole proceeds went to our employees and were distributed very simply based on how long you were with the business. And so for like people who were more than 5-6 years, that was up to like a 2-year salary that they received. And we had a long conversation there around, yeah, but should we also bound that somehow that people stay for a while, and should we make it as an incentive? And I was like, no, I don't think so. Actually, it is what we're doing is we are rewarding them for being part of that journey until the point where we are right now. And they have been with us for a reason, for a time, and I trust they will stay. And I think that was for us the second moment where we were able to demonstrate trust. And just said, hey, thank you for being with us. Thank you for helping over years to build the company we had. And it's so, I mean, it's so beautiful when you then get people like, hey, finally I can build my bathroom I always wanted, or I can make my house extension, or things like that. You know, it's like you actually make a difference for people. And am I super grateful to our investors that they believed in us and we were able to make them a ton of money? Yes. But when you think about how much of a difference did we make in their lives, well, we made a big difference in the lives of our employees. So I think that was the second moment of trust. And then the third one is communication. It's like we had pre-closing, pre-signing, post-signing, and then post-closing, and then during the merger integration activities. Just communication very high, things that go well, things that go bad. I held probably every month at least an Ask Me Anything session. And one thing that I personally learned or grew at with was like, you cannot avoid that there is anxiety and there is feeling of like, oh, they're going to destroy something, or our culture is going to fade, or XYZ. And my natural answer to that is always, oh, it's not going to be that bad, blah, 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 blah. And trying to sell the beauty about it. And I got one comment from one employee, an extensive comment on like explaining that it's not about we believe you and it's all good. It's just about moaning. It's about give me time to digest, it's okay to feel sad for a moment. And for me, that was a huge lesson learned for me personally, that sometimes it's also just, it's okay. And the only thing they need is a hug, or the only thing they need is just, you are emotionally there and you understand that there are uncertainties. You understand that for some people, anxiety is something difficult, and it's okay. It's okay to feel anxiety. It's okay to feel maybe scared for a while. And having that empathy, I think, was then sort of the third ingredients really that helped. High communication, being open, and having understanding for also the tough feelings that come with it, and they are okay. And they will go away over time, and that's okay.
Really well said. I have a quick follow-up question, a really short one on the second point. The 5% that you distributed to the employees, was that part of a stock option plan, or did you simply make these funds available as an unannounced bonus, so to speak?
So it was completely unannounced. It was unallocated. So obviously we had people that had stocks, stock options, and
Right.
so on. So they participated anyway as part of their stock option program. But that 5% was unannounced. No one knew it. It was something that I personally wanted to do when I do an exit ever. But I didn't want it as an incentive. It wasn't that people stay with us, or no one knew it. It was just, I wanted to do it. And fortunately, I had the support from board and from our shareholders to actually do it then also.
Man, I really, really love that. Big respect for doing that. I think that shows true leadership. Like, really, really well done. I really admire that.
Thank you.
We also will
I mean,
get a few more questions. Yeah, it's beautiful. We have one follow-up question. I think it's on what you said before, Laurent. Here's from Nicolas, and he said, shouldn't the selection of team, early customers, investors, and exit options all be taken before incorporation? So I think it was mainly about the exit option where we said, well, maybe, maybe not. What's your answer to his question?
Ooh, now we need to be careful because Nicolas was the guy that brought me into entrepreneurship. So if I now go against what he's saying, then I'm in big trouble. But he was the leader of a venture kick course. I think it was back then that actually brought me into entrepreneurship in the very first place. I mean, obviously, ideally, if you can, or if you're in a position that you know those markets, or that you have the visibility, then yeah, before incorporating, try to think about these things. I was a bit like To when I started. I was a greenhorn. I had no clue about all of these things. So any strategy that I laid down then, 6 months later, would be completely obsolete, because I've learned so much about how these markets work, how the players in these markets work. I was 100% convinced Movo would be bought by a media company. It ended up being an insurance company. So yes, I think whatever investment you can do in the beginning to research this, to come up with an idea or a mindset and a plan makes a lot of sense. But you'll throw it away 6 months later because you learned so much in the first 6 to 12 months of running your business, that it all changes and you have to do it again.
So it's a good exercise, but it will not be reality in the future.
Yeah, I mean, have a plan, and then when reality hits, you need to change it.
Exactly. Lars, I want to get back to you. Let's say we fast forward. We're now in the middle of actual talks with an interested buyer. And of course, the biggest thing that comes up there is always the valuation. How do I determine the valuation? I know you probably have raised some funding, so you have at least a bit of a guess what the VCs value your company with, but there's still probably a lot of different perspectives on that topic. How do you get there?
Yeah, I think there again, it really depends, right? I think it depends on the market that you're in, what is happening there. I think when you are in a market where a lot of dynamic is, and there is companies being sold, I think you will find out what the valuation was of these companies, the multiples that they had on their revenue. I think, yeah, and then it's also the story, right? What is the purpose of the acquisition, right? Is it just like the clients, is the technology? Do they get amazing talent on board? I think that also comes into play. So yeah, it depends. But I think that if you do some research on like your competitors and what is happening in your market, you will get a quite good understanding what valuation you can ask for and what is realistic. And I think also the market has changed so much. If I look back at Series B in 2022 and then our exit in 2025, it's a complete different game. And also, it is so interesting because when we raised Series B, it was all about growth, all about logos that we won, about ARR that we closed. When we went to the exit, it was about, okay, how many clients do you have live? What is your time to go live? What is your net retention look like? Are the clients really happy? We want to cold call clients. There's like a lot happening that is not just facts and figures, but it's also way more, okay, we want to understand like how do your clients take? What do they want? How do they talk about the solution? We want to talk to employees because also that is so interesting. And I thought that was also really cool by Travel Perk, the way they did it. It was also, they did a lot of culture check.
Nice.
And they're also experienced in buying companies. So we were the third acquisition that they did, the largest one so far, but they already had 2 acquisitions before. And they told us, look, the most important thing for us that this works out is actually compatibility, right, with the culture. Otherwise, you can buy any company you want. If that doesn't work, then it will not be a success. And so I think this also, plays into what you said before, because it was not just the technology, it's also the expertise that we brought in, and that expertise is carried by our employees. So of course we also have key employees that they need to be happy, they need to feel good in that new environment, because there is a lot of change, right? It even if the culture is very similar, there is so much change happening, right? So you want to get these things straight. So I think that does not determine your valuation, but I think it's a very important point to mention there too. So it has changed a lot on how these conversations go and what they look at. It's very different from a funding round, right? Also the compatibility of your technology, and how will this look like, and how fast can we build it, and what is happening in the market. So there's a lot of these factors that come into play. But still, I would say, if you look around in your industry, you can get a feeling of what valuation makes sense.
Usually in the SaaS business, you work with an ARR multiple, right? Because you have recurring revenue that's super valuable. What was the multiple on the ARR that you got with your exit at Yokoy?
So I cannot say the multiple, but if you just Google right now for 2025, what are the multiples on exits? We were on the higher end of that, and that also because it's not just 2 businesses that go together that do the exact same thing. There is a lot of upside, right?
Yeah.
So that also, I think, actually makes sense to have a higher valuation, right? You can argument that it's a higher valuation because there's way more upside.
Tol, switching to your experience, let's say you've raised a VC round not that long ago. You got a clear valuation on your company there, but now you're in the exit talks and you want to push that valuation higher. How do you do that? What's the story that you tell to the potential buyer?
Well, I think, for us, we tried to sell SHERPANY for the first time in 2018, went through the process, confirmed due diligence until signing, and in the end said, sorry, it doesn't work, the price is not good enough. So we walked away. And that told me already, that was, I think, the best thing to do is like make a dry run, try to sell your company without selling it. I think that is probably the best preparation you can do. It's hard. It's hard for the company. It's energy draining, but it's a super preparation. So my key learning then out of that was, you can tell a lot of stories and it does influence, but still 80+% comes down to hard facts. Like, okay, what is your ARR? How sticky is your business? What your net retention? How does it really work? Or when it's a tech acquisition, how solid is your tech really? How many IPs do you have? How valuable are they, right? So at least I would say in later stage, right, where we were, our buyers put a lot of money on the table, so they are diligent. And you thought due diligence through financing is hard. It is not. It's like you do an exit to learn what due diligence actually means, which is good, right? It's good because they take it serious. They really look at. For me, the key learning to drive valuation besides story, which is obviously it needs to have an economical reason at the end of the day from a customer's perspective or from a value creation perspective, either for the customers or because of competitive tension, they want to take out a competitor, or because they open up a new field where they are not in yet and you have some big top line synergies.
What was the ARR multiple that you got?
At the end of the day, but the driver at the end of the day is competitive tension. If you get multiple buyers,
I agree.
Love it.
Timing is also key, and what is happening in your market.
Yeah, you need to have multiple parties interested so you can play them against each other to drive the price. That's the best if you have a scarce resource to sell and everyone or multiple parties want to buy it.
But I think, Silvan, that's the same when you raise a round, right? So when you have a lot of people interested, that will benefit you.
That's true. To, are you able to share the multiple that you got on your exit on the ARR?
Yeah, so it was in the very high one-digit number on the ARR where we got. It was but we got there through competitive tension. Like our story was, right, we had an inbound, we had multiple, you have millions of requests over time, but we had one very serious inbound that came in, which was at a lower price. And to your question, or to what Lars said, look around, yes, but also, I don't know, you need to have a feeling for what your company could be worth. So when we looked around, the inbound offer was decent, but I just wasn't ready to settle for that. The tension started actually because within our board, we had a board member that was like, but it's decent, and what if that is the best offer we ever get? And
a very Swiss answer.
Yeah, what now? And so that pushed us at the end of the day to hire an investment bank and properly go through a process. And we ended up being able to really build that competitive tension for a first round, a second round, up till signing, including like a shootout at the end. And that drove our value. And I think it drove, at the end of the day, I reached the value that I originally had in mind. But I think if I would not have had sort of a feeling that there is more, we would have settled earlier.
Yeah, makes sense. And this is actually also a perfect segue to the other question that came in from Daniel. Would you always recommend to appoint an M&A advisor for your exit? I think Laurent is already nodding. You say it does make a big difference.
I mean, I've been involved really only from the sidelines at the Dine deal transaction. I've been heavily involved at the Movo transaction. I've seen from the sidelines, I would say maybe 5 more transactions, and I've been on the buyer's side in 4 transactions afterwards. And I can tell you, the guys with an M&A advisor that knows his job are the ones that get the best value. Simple as that. Because there's so many dynamics for that. One is their network. They understand the market. They know who to approach to that you might not get to otherwise. So it can increase competitive tension. Secondly, they will make your company look 5 times better than what you're able to do by yourself in the pitch decks, in the investors reports, etc. They can really level you up there to look professional. And then thirdly, in the negotiations, if you're planning to stay on in the company afterwards, you cannot be the bad guy. You need to be the good guy or the good girl. And there needs to be someone else that is playing this role for you. And that's usually the M&A advisor that afterwards the guys say, oh, they were really, really a pain in the ass. But they're driving the value for you, right? So yeah, anyone that wants to do it without it, go ahead, try it. But I can very concretely say that I believe you will be getting less value than if you had an M&A advisor. And you even need to pay them a cut and everything, that's clear, but they'll drive more value than what they're taking as a share.
Lars, did you work with an M&A advisor in the exit process?
Yeah, and I echo what you guys said. I think it's important to have a good M&A advisor, have a good tax lawyer, also understand what are the implications for you, for the team. I think that is really, really important. It saves a lot of headache.
Right. And where do you find these people? Who are great people to work with? I'm not sure if you have any shout out to make here, To, Lars, Laurent, but where do you find these people? That was the second part of the question.
And maybe I have two thoughts on that. So I would obviously second. We also worked with one or with an investment bank. I think it depends again on your size. If you do an early exit and your enterprise value is accordingly low for an early exit, in absolute numbers, relative numbers might be super interesting for investors and for you personally, but in absolute numbers, you're going to have a hard time to really get a very good one. So I think what can go wrong is like if you have to settle for mediocrity, it might create more headache than it actually helps. That's sort of where I would
agree.
Have a word of caution on like just go for an M&A advisor no matter what. You need to be able, your deal size need to be able to afford a decent one, to have a positive impact and really drive value.
I think you have worked with GCA, Laurent, right? Back in the days with Movo.
Yes, we worked with GCA, now part of Holy and Loki. I've worked with Meridian Partners, Heiner, who's a great guy.
Agree.
I've worked with Daniel Schreiber from Progressive. I've worked with a couple of other people now, by now. All of them are in their area fantastic. And the way to find them is, I mean, you have investors usually. Investors, it's not their first rodeo usually. So they have a couple of people that they really trust in. And through them, you'll end up at the same, I would say, 10, 15 firms in every industry that are recommendable. And then I think what To said is important. You really need to get a feeling for who is the best fit for your company. It doesn't need to be the biggest logo or the biggest partner or whatever. The earlier you sell, the more it's going to be a one or two people company rather than a big investment bank or a big M&A advisory. They're also not going to take you on, to be honest. So really figure out who has the right fit for you from a cultural perspective. So, for example, what I really loved about working with Heiner always from Meridian Partners was his transparency. He's not bullshitting any buyer, and that's what makes him so credible. People really listen to him because they know if he tells you something, it's 100% the truth, right? And that's been reflected on the buyer side as well. So there's different people with different styles of approaching this, but at the end of the day, I think through your investor network, you will find the right potential partners, and then it's down to you to interview them well and figure out who is the right one.
Absolutely. Yeah, we also did an interview with Heiner. We also worked with him in the past. And one guy I would love to work with is Jonathan Roberts from Minalto one day. He seems a really cool guy. We also had a podcast with him, but never a chance to work with him yet. Maybe in the future. Guys, I want to go through some negotiation.
Like on what Laura said, I think it's important. It's make a proper like beauty contest selection process. It's like recruiting your next CFO. Like,
absolutely,
go through a proper process, because you're going to get advice from left, right, up, down, and your long list is going to be created like that. But you have to select it yourself.
100%.
And by going through that, you learn so much on like what actually matters.
Yeah. I think that's the value of having all three of you here who have actually walked that talk at least once or even multiple times. I do want to wrap up this little chapter of the exit part per se with really a story from each and every single one of you. Give us your dirtiest, your most intense negotiation story along the exit route. Maybe we start with you, Lars, then Ton, then Laurent.
Yeah, I think there's a lot, right? You have to negotiate, and I think we talked a lot about valuation, and I think there is more to it than just the valuation. I think it's also, especially if you sell for high amounts, right? What is the ratio of cash, shares? What is going to happen with your employees? Are they going to get cash? Are they going to have a stock, a share in the new business? What is going to happen with you as a founder? Are you going to stay? How is that going to look like? So I think that is a very important negotiation to have, also because it's also about your your own freedom and making sure that you yourself are bought into that vision, and also the team is. So I think for us, I mean, the valuation was one part, which was tough, obviously, to negotiate. But I think it's a way more natural negotiation that you do if you're anyways in a business role, if you sell, if you raised rounds of financing before. I think it's a very similar game. I agree. There's like some more depth to that. But I think stuff that comes up that is actually quite new for any founder is everything around it, right? Because just because you sold the company doesn't mean you get it all in cash or you get it all immediately, right? So you have to make sure that you find something that works for the founding team, that works for the employees. I'm also extremely proud. So by the way, also a big shout out on what you guys did with actually having the team participate on that exit. I think that is really important. What also for me was a very very beautiful moment is that we could offer, and it's also something that we negotiated, that we could offer to have the team that has shares of Yokoy, that they could sell those shares, right? So we had some individuals that made a lot of money, like really a lot of money, life-changing money, right? And unfortunately in Switzerland, we don't really talk about that so much. But I think that is also like one of the roles you take as a founder of a business, to make sure that they also benefit from that exit, and that they're also motivated to stay and to make the business better, right? So I think these conversations, these negotiations were quite tough, because you have different interests that collide, right? I think usually your buying party wants to lock you in as long as possible, which makes sense from their point of view, right? You want to make sure that you get the talent for as long as possible. You usually, as an entrepreneur, you want to have more freedom. You want to be able to build new things, right? There's usually also a middle way that can be found, that you commit to some time, but you're able to sit in board seats. You can invest into companies. I think also for your employees, you have to negotiate that out. So actually, that stuff was for me was really, really tough. And yeah, I think also the situation is also different for a lot of for some companies. There is there's an earnout bonus, that is taxable, and there's like a lot that you have to discuss there, and you have to negotiate, and you have to make sure that in the end stuff works out for you, right? Because I think whenever we talk about exit, everyone always talks about the valuation and what price is going to be paid, but there is way more to that than just that. And I think that is really important, and it's also tough to negotiate, because usually you have different interests naturally, which makes sense. If I will buy a company, I would also want to make sure that the founders stick around for very long. They will help to do the integration. I will pay the least amount of cash in an environment where money is not just floating around. So I think that is the really difficult part of the negotiation.
Got it. Yeah, it's all these different interests to make them align. Got it.
Yeah. And you also have a board, right? It's not just you have shareholders, and you have to find a consensus. So I think also, if I look back at our deal, what was really the tough part was to have everyone aligned on like, how do we go forward, right?
Yeah. So what was it for you? I think you told us you had like a shootout at the end, so I'm sure there's quite some stories to share there.
So I think we had in many ways an extraordinary situation. Laurent was like, bankers drive valuation. Yes, in our case, at some point they were like turning to me and like, hey, stop it, you're gonna lose the deal. And I was so in adrenaline, the rush that is like, I can do a bit more. There is one more round to go. But yeah, in our case, I think we did sort of three things. One is I think we had a good alignment very early on in the board. We way earlier already, about a year or 1.5 years earlier, we had those conversations with our investors already on like, how does good look like? When would you be happy? What would sort of a return for you be acceptable and so on. So we had a lot of frames around that gave us a lot of freedom on like just focusing on making a good deal at the end of the day happen. So that really helped. We also, when we went out very early on with my management team, with the board, with the founders, we sort of wrote down one page, a couple of points, like what is really key for us, like what makes or breaks a deal. And one of that was cash only, like
Nice.
everything now, one clear cut. And even though you hear that not being possible often, and many told me, forget it, that's not going to happen, it's impossible. But if you have those clarity and you go in very early on saying, hey, we're open, we're ready, but we have a couple of things that are super important to us. And one of them is a clear cut. And second for me was, I also want a clear cut, like if you want people to be incentivized moving forward, that's post transaction. Make sure that we have an incentive program, or as a new combination, you have an incentive program in place that incentivizes. But what I didn't want, where I was really against, was like, just because people took a lot of risk in the past and were vested and were like dedicated and contributed their life and sacrificed their family in the past, to think about, for me, the exit is a moment of like reset and appreciation for what got us here. And there is a lot of this rollover thing, is a lot of like, hey, it's great, you made everything, but I'm going to put you some chains on anyway. And this was a feeling that I didn't want. And I'm not saying one is right or wrong, not at all. But for me, there was like, that's where we got clarity. These are things that we will not accept. And that also made it clear for us, we will need to have competitive pressure and competitive tension until the end. Otherwise, it's not going to work. Forget it. Yeah. So we had to go through confirmatory due diligence with 3 parties at the same time, which is like, you're 24/7 just answering stupid questions in your data room and explaining for the 100th time how accrual of vacation is working, how you do this and how you do that. Because all of them put like a team of advisors then behind, right? And so on. So this is sort of what you have to go through. But for us, it was clear we were needing that to be able to somehow get close to on those like 5 key points that we had, to get close to them.
That must have been a huge relief for you till after you were done with all that work, because you still had a business to run. You must have been extremely exhausted after that process.
Yeah, fun stories. Like, so obviously you have this whole front running. So we had like hiring an investment bank, then roadshow, finding like our target or our potential buyers. We had about 7 offers that we got. Out of that down selection, that was sort of November, December, happening before Christmas. And then after Christmas, we went into confirming due diligence with 3, right? So it is a marathon. You continue going and going. And when we entered that phase, I was like on steroids. I was super pumped. I was like, I kept going. You fly around the world all the time, and you have to somehow remember at 3 o'clock in the morning, what did I say to that one? And what did I say to this one? And not mix up and these kind of things. But I felt like top, like adrenaline was pushing every day. And towards end of January, beginning of February, I met for a coffee in the morning with my mom. And she was like, she looked at me, she was like, what happened with you? Are you okay? I never saw you look that shit. And I was like, seriously, I feel great. I feel great. But yes, it left some scars after that. I was like, and then right, you have getting to the deal, getting signing, then from signing to closing, then kicking off post-merger integration and make sure that sort of things get out. It doesn't stop when you sign. So it took until sort of Eastern until it pressure relieved a bit. Yeah, but then I was sick for 3 months. Like I carried like until everything was out again. It took also a while to recover.
Holy moly.
It's so funny, Toe. It's so similar when I hear that story. I see so many parallels because it's not like a cut, right? You sold your business now, and now you can relax. The integration starts. Yeah, for us, it started already after signing, before closing, right? You already started to announce and to integrate, and there's so much stuff happening, right? So it's not that you can just take some time off. So it is a quite intense period.
Laurent, we don't want to skip you. Sorry, Lars. We don't want to skip Laurent for his story.
I have
Laurent,
a
you have
million
anything
stories.
to share with us? Yeah, of
I
course.
have a million stories. So let me just try 3 minutes to pack as many into 3 minutes as we can. Let's go. Number one, we went to a potential buyer. The M&A advisor, I'm not going to say his name. I love him, but yeah, I don't want to say his name. Was sitting there typing on his mobile phone the whole time. He looked up once in 60 minutes of meeting, said one angry sentence, like everyone was a bit startled. That was it. We left the building. He turned around to me and said, those guys are going to buy you. And he went on for a 10-minute explanation why they're going to buy us. And I was like, what the fuck? What are you talking about? Yeah, funny thing, they ended up buying us. So he was right 9 months before. Second story, we were also having competitive tension, negotiating with a couple of companies. I wanted one of them to buy us really badly. I was in communication with the CEO. One morning, I have a call with him to negotiate some stuff, and he was really angry in the call, and I didn't get why. And he said, the deal is off, and he hung up the phone, and the deal was off. 3 years later, he told me, that was a stupid decision. I just had a skiing accident that morning and was in a bad mood. I should not have called off this transaction. So, you can do everything right, but you get the person in the wrong moment. So timing, as Lars said, is super important. I only learned that 3 years later. And one other story was, in our case, it was the opposite to Toe, where they were trying to slow him down at some point. One day, the advisor called me and said, Laurent, look, I understand that you want to go with company XYZ, but we have to make a decision now. The shareholders want to go the other direction. What do you need from that company in order to go with them? And then basically it was my wish list, right? So I was able to give them a wish list. And I thought, never, ever are they going to accept all of this. But they did. And it taught me that I could have asked for much more in that scenario. Also, the investors came back to me afterwards saying, hey, man, you took care really well of us. It would have also been easy if you would have put a little bit less money on our side as the investors and put a little bit more on your side. So that was also learning for me. I've always been too generous in life with everyone around me, and I should take a bit more focus of myself. And the last one was, I think Toe managed that much better than me. Having the company employees as shareholders, which we had almost everybody participating, and I was quite honest and straightforward with them. But I didn't inform them well enough during the process. So at one point we had a sort of crisis meeting where all of them would tell me what they were thinking of the process and where we stand. And that was so under pressure and running everywhere. That meeting was a catastrophe. I was yelling, then I was crying, and then we hugged it out in the end. So then it was fine. But that was really the low point for me, that my team basically turned around saying, we don't feel supported by you. And it was simply because I was really not doing a good job at keeping them involved into the communication at that point. I would have 50 more stories, but that was 3 minutes.
I love it. Amazing stories. Thank you for sharing them. Now, before we wrap up, we have about 5 minutes left. I do want to do a few really, really short questions to all three of you, talking about your actual exit. I know you're not going to give me your numbers for how much you sold for. I know there are NDAs in place, etc. But maybe we can do a little game. I give you a number, and if you are above that number, you raise your hand. Let's try if you're up for that. Who sold for more than 10 million? Let's do a little warm up. More than 50? More than 100? More than 200?
I will stop here.
That's good. That's good. Well, in some cases, you also don't know because there are shares involved. So it could be anything. But cool. That was super helpful. Thank you for playing along. Now, what did that mean to you when we sold? Like, how did you celebrate the exit? Maybe you go the other way around. We start with Laurent, then Ton, then Lars. How did you celebrate the exit?
Obviously, we had a party with the team. I think that's very important. Then we had an investors dinner with the investors. And that was about it. Honestly, after that, I looked at the bank account. I was happy. And then I was back to work. And I realized that it's just, I mean, it is life-changing in a way. But if you're driven by what you're doing, you're not going to change that much as a person. So yeah, that was the sort of frustrating learning that I've been chasing this. And afterwards, yeah, you just keep going because that's what you want to do anyway.
Cool. To, how did you celebrate despite being sick and catching up?
Yeah, that was still part of the adrenaline. There was still some adrenaline in there. So I got over my whole period. I always got the critics that I celebrate a bit too little on like small achievements and so on. I'm always like, okay, let's move on. What's next? Go forward. So this time I was like, I want to do it right. So we had a whole lineup of celebrations with investors, with founders, with actually different groups of investors, with the board, with employees in different locations, with the buyer, with the advisors. So it was like, I think over 3 weeks, we had like 8 or 9 different like celebration parties and moments where we celebrated. And one of the key things was I was always saying that exit is the most stupid name for what it actually happens.
I like that.
I agree. For us, it was we did a roadshow. We went to every office, so we celebrated in every office. If I look back, if I reflect on our exit communication, I think we did a lot of communication. We did that quite well. I think we should have partied more. It was also because we started to work so fast all together. So we planned a big party. That was amazing. I think nothing beats that. But until that big party, we could have done a little bit more celebration, but we were so focused. But that party in the end was the summer party with Travel Perk, where we flew. So first we did an integration party, but then for the summer we did a huge festival. It was really a festival. We were like 1,500 people. That was amazing. And unlike anything I ever experienced. So that makes up for a lot of it. But if I would go through it again, I think I would do more celebration also with the team. We did some, but I think we could have partied harder.
Nice. Guys, we are almost out of time. I have one word answer for the last question for you. What is something that you did with your money that you purchased for yourself, an investment that you made? Just one thing that you can share with us that you did with the money you personally made in the exit. Let's start with To, then Lars, and last Laurent.
We bought a house.
Nice and simple. Lars?
A watch.
Of course. I'm not surprised. And Laurent?
A house, the startup investments, and some other funny stuff.
Amazing. Guys, we ran out of time. I could go on for another hour with you. It's so easy, but we're going to stop here. I really appreciate all of you taking the time. It was super insightful to learn more about how you negotiated, how you drove valuation. And thank you just so much for being here and for giving us your time. Big thank you.
Thank you.
Thank you. And I also want to invite all the listeners, if they have questions in that period, just can reach out to me. And I'm sure also to Lars or Laurent, whenever. Sometimes
Absolutely.
Always.
You're lonely in that moment, and sometimes just some outside in.
Amazing. That's the perfect way to end. Thank you so much, guys. Enjoy the rest of your day and see you next time. I'm sure we'll have plenty more to talk about. Thanks.